Okay, could I? Let's get started. I know I've said this before, but it doesn't hurt to repeat it again. Your quiz is Monday. First 30 minutes of class, so don't come late, otherwise you'll miss most of the quiz. It is open book, open notes, open iPad. So again, I want to make sure that everybody gets it. Not open laptop. If you're going to miss the quiz, what do you need to do? Let me know before the quiz. Keyword is before. So once you get to 10:30, it's done. So basically I've got to assume, because otherwise you will have people taking the option to take the quiz, which is you might take the quiz and discover it's not that good a quiz and say, I wasn't there. So I know you're honest, you would never do that. I'm talking about the other guy, right? Just if you're going to miss the quiz, you need to let me know by 10:30 or before 10:30, 10:28, 10:29. I'm okay. I'll check the email stamp, and it's before 10:30. We're set. Okay? You know what happens if you miss the quiz. If you don't, go back and read the syllabus that I gave you, because it sets out in excruciating detail what happens if you miss the quiz. Okay? So that's the first thing. The second is there is a review session on Friday, 12 to 1. I don't know what room number I gave you in the last one, but I was able to move it to 260, which is a little better than 170. 260 fits about 175 people, so which is obviously smaller than this class, but my prior experience of this is about half of the people show up either because you have other stuff or you think you already have the stuff nailed down, whatever the reason. But if you're not able to make it and you want to watch it, it will be up as a webcast later by 3 o'clock or 4 o'clock or maybe by 6 o'clock that evening. Okay? So it's on Friday from 12 to 1. Any other questions about the quiz? It'll cover everything we do through today. So today's class, and I'm going to give you a preview of this, is not a difficult class, but things will build. So if you are numbers challenged in any way, and I won't name any names or give any backgrounds, it will seem daunting. Not because each number by itself is difficult, but because the numbers pile on top of each other. So what I want to start off with today is 3 numbers that people use interchangeably and very badly out there. And I say people, I'm talking about bankers and analysts and CFOs. So to illustrate these 3 different numbers we're going to be juggling in the air today so that you're very clear about which one I'm talking about at any point in time. I took Apple as of yesterday. I did a valuation of Apple in my valuation class. If you're interested in my valuation of Apple, you can check it out on the webcast page for the valuation class. And as part of that exercise, I drew up a financial balance sheet for Apple. As opposed to the accounting balance sheet, which you can get from a traditional balance sheet. Remember, financial balance sheet is market driven. Okay? So this is what the financial balance sheet for Apple looks like. I started on the right-hand side of the equation because that's what I can observe in the market, and I looked at the share price times the shares outstanding, and the value that I got for Apple's market value for its entire equity right now. So this is just the share price times number of shares is $752 billion. So the answer to the first one, what's the market cap of Apple? Market cap measures just the market value of equity. That's easy. It's $752 billion. Now I'd like some help as I go through the rest of the questions. What is the market value of Apple as a company? These are the different questions. I'm not asking what's the value of Apple's equity. I'm asking what's the value of Apple as a company. What's the answer to that? It's 752 plus the 41 billion because debt is part of Apple as well. So the market value of Apple as a company is 793 billion. We're going to call that the firm value or the company value. So the market value of equity is 752 billion. The market value of Apple as a company is 793 billion. Let me ask you a third question. Apple has assets, right? Some, of course, we know about the smartphone. And in a forward-looking perspective, these assets are what you generate your operating cash flows from. Smartphones, computers, iPads, retail. What is the market attaching as a value to Apple's operating assets? And that's going to be 793 minus the 178, which is 615. That is called the enterprise value. So when you hear analysts talking about enterprise value, I don't think they often know very well what they're talking about, but this is basically what they're trying to measure. It's the market value of the operating assets of the company. So let's review. The market value of Apple's equity is 752 billion. The market value of Apple as a company is 793 billion. And according to the market, the value of its operating assets is 615 billion. Now remember we talked about levered betas and unlevered betas and all that neat stuff last week, or not so neat stuff last session. Let's kind of bring them into the process now. When I talk about the levered beta or the regression beta for a company, what item does this? So we have a value for Apple's equity, value for Apple as a company, value for Apple's operating assets. Which of those 3 values is a regression or a levered beta most attached to? Is it to the equity, to the company, or to the operating assets of the company? It's to the equity. So whenever you talk about a levered beta or a regression beta, you're talking about the beta of equity. When we talk about the unlevered beta for the company, we're talking about the beta in Apple as a company. You're saying as opposed to what? What if I asked you what the unlevered beta for Apple's operating assets are? Do you see why it's a different question? The unlevered beta for Apple as a company reflects its 2 different businesses. One is, of course, its regular operating business. The other is the cash business. And the cash business is 22% of Apple. And the beta for being in the cash business is what again? Remind me? It's 0. So they're in two businesses. 22% of Apple is in the zero beta business. 78% of Apple is in this risky operating business. If you ask me what is the risk in Apple's operating assets, it's not the regression beta that I should be giving you. It's not even the unlevered beta. I should clean up that unlevered beta. Do you see what I mean by cleaned up? Because when I give you the unlevered beta for Apple as a company, it's going to be too low because it reflects that 22% in cash. I call that an unlevered beta corrected for cash, but some people call that a pure play beta. So if you hear me using those two words interchangeably, what I'm trying to estimate is the beta of the operating assets you're in. I know these are a lot of terms coming at you really fast, but take a look, keep tabs on those numbers. Market capitalization, value of the company, and enterprise value are three different things. Regression betas, levered betas, unlevered beta for the company, and unlevered beta for the operating assets can be three different things as well. Because today we're going to use those, all six of those numbers along the way, and that's why I said things start to pile on top of each other, because what beta are we talking about now? Even if you get confused during the course of the class, go back and take a look at what we're doing, and hopefully it'll start to make sense. Okay? So you ready? Let's go back, because what I left you with was this process. So let me go. I think we were on. So what I said was I was going to try to estimate a bottom-up beta, beta for your company based on the business you operate. Let me very quickly list the steps involved. First step in the process is you tell me what business or businesses you're in, right? Second step in the process, I estimate a pure play beta for each of those businesses. Beta for being in the business. Third step, I take a weighted average of those pure play betas based on how much value you get from each business. Fourth step, I look at how much debt and equity you have to come up with a levered beta. 4 steps, right? I'm going to try to go through those 4 steps for Disney. And because it's a real company, I'm going to run into real problems. And this is why I want to work with real companies. I could create an XYZ widget company and everything will work smoothly. But in real companies, you are going to run into roadblocks. And I want you to think through the process, because you are going to run into roadblocks when you do your company as part of your project. Yeah.
So from a beta perspective, is it correct to think of cash as a hedge against the market?
Cash is it's not even a hedge. It does nothing. A hedge against the market would move in the opposite direction as the market, right? So if I took the cash and I sold short in the S&P 500, I could do that. That would be a hedge. If I took the cash and I was an oil company and I sold oil futures, that'd be a hedge because it moves. It's not quite a hedge. It just does nothing. It's a nothing asset. It just sits around doing nothing no matter what the market does. So it's a stabilizer. And that's how we use it in our portfolios. Why do we have cash in our portfolios? Because it allows us to have at least a portion of the portfolio that when we check tomorrow is going to look very similar to what it did today. So it acts as a stabilizer on the company, for good or bad. Okay? So let's try to use this approach for Disney. First step is what? Finding out what business or businesses Disney is in, right? One of the things I never do when I pick companies and use them in my books is talk to the companies themselves. You know why? Because the minute they start to give you information, they feel that they have the right to then check out what you write and say, hey, I don't like that, don't do that. You got the information from me. So I can say mean things about Eisner and get away with it because Disney's never been involved. But luckily, Disney is a publicly traded company. To find out what businesses it's in, I went to its 10K and its annual report. And Disney breaks itself down into 5 businesses. And it gives me a substantial amount of information on each of the 5 businesses. The reason I say that is some of you are going to have companies that are in 3 or 4 businesses, but they give you a lot less information than Disney does. Here are the 5 businesses of Disney. As I go through each one, you tell me what you think is in each business. Let's start with the first one, media networks. What's in that business for Disney? ABC. Keep going. Disney Cable, ESPN. They also own a piece of an Indian TV, NDA TV or something. So there are TV companies in that business, mostly broadcasting companies. What's the biggest part of those? You listed 3 or 4. ESPN is it's the tail that wags the Disney dog, which is kind of strange because in 1996, remember that Cap Cities acquisition? ESPN was the rump that they threw in. You want it? Disney almost said, no, what are we going to do with a sports channel that nobody watches? Today, by my estimate, ESPN alone is half the value of Disney. It is the ultimate cash cow. And here's why. How many of you have cable? Okay, you get that bundled bill, right? That's actually revealing. Cable companies should be scared because 3 years ago, I said, how many of you had cable? Everybody would have their hands up. You pay cable bills. I'm going to pick. You said you had cable? You had cable? Okay, how much do you pay for your cable? It's personal. A lot. $100, $80 for the bundle, right? 750 channels, most of which you don't watch. You know how cable companies get these channels? Is they pay each of these channel providers, whether it's ABC or a home shopping network. You know how much every month you're paying to the cable channel to pass on to ESPN? $6 a month. Think about that. You take every cable bill in this country, $6 every month, ESPN. The next highest is $1.10. And there's a very simple reason for that. ESPN is the only thing that stands between cable and the abyss. You know what the abyss is? My son doesn't have cable. He has Hulu plus Netflix plus he has his own little collection that he's created, and he's okay with it. But this is my 25-year-old, but my 25-year-old is never really into sports. He's okay with it because the one thing you're going to miss if you lose cable is live sports. That's ESPN and the abyss, which gives ESPN incredible bargaining power because they say, we're going to charge $15 a month. The cable company says, oh, we'll scramble somehow to get it. Remember last year when ESPN shut out CBS? You might not have been in New York, but they actually shut out. There was a fight with CBS. They said, we're not going to care. It was not, Time Warner shut out CBS because they had a fight with. No cable company will ever be able to shut out ESPN because if they did, the game is over. So it's only a matter of time before ESPN says maybe we can charge people directly $8 and bypass this cable guy. But it's too lucrative right now for them to do it. So that's in the broadcasting business. Disney, ESPN, Disney Cable, ESPN, ABC, and these little assorted networks that they have in other countries. Parks and resorts. This everybody should know, right? What's in there? Disneyland, Disney World, Hong Kong Disney kind of just getting started. Euro Disney and Tokyo Disney, Disney has a different arrangement with those. It doesn't actually own those. They actually get a management fee. It's a different kind of income stream. But those are all in there. You're saying, what are the resorts? What's in there? What's the Swan, the Dolphin? Let's face it, these are the places you would never visit unless you absolutely have to. And you go to a Disney theater. I mean, it'd be silly to stay at the Swan because you're business in Orlando. You've got to drive on 4 all the way like 50 miles inland into this deserted area, and you've got to come back out. Right? So those are all bundled together. You know what else is in there? The cruise ships are in there as well, because their argument is you don't pay twice the price you normally pay for a cruise unless you want to see Mickey. And they're probably right. So that's all in the parks and resorts. Studio entertainment. What's in there? Let's start with the classic Disney movies. But what else is in there? Pixar. Keep going. Lucasfilms. You're missing one small. Think Avengers. Marvel. It used to be Touchstone. So this is actually this motley crew of movie companies. They're all valuable, but they're very different companies, all under the movie business. Consumer products. This is actually everything they can't find a place for gets dumped in here. So licensing, toys, software, etc. It couldn't live on its own, to be quite honest. It lives off the other, and that's actually an interesting point we'll come back to because it lives off the movies. If you did not have Frozen, you would lose half your merchandise here, right? And then there's this final business they call interactive. You know what that is? It's a business that's not done that well for Disney. It's a gaming business. You might have seen, I don't know what Disney Infinity, I think is what it's called, the newest. They've had trouble with it, but basically it's their attempt to be part of the gaming business. 5 different businesses. My task is laid out for me. They lay out the numbers at least for the businesses. What do I need to do? First step, I need to come up with a pure play beta, for being in each of these 5 businesses, right? So here's what I'm going to do. I'm going to take each of these 5 businesses and try to come up with a beta for being in that business. Let me be specific. A beta for being in the gaming business, in the theme park business, in the movie business, in the broadcasting business, and in the consumer product business. So I'm going to start in the middle, and I'll come back and talk about why I'm going to. I started with a business where I had a fairly easy time, and then we'll go to the businesses where I had a tougher time. The movie business. Here's what I defined as the companies. Remember the process here, find publicly traded companies in that space? I found 10 publicly traded companies that were US based and were in the movie business. Only 10? I know it's only 10, but if I have 10 companies in my sample, how much more precise is my beta going to be already than one regression beta? Just take the square root of 10, which is 3. So basically it's already 3 times. Would I like 100? Sure, but beggars can't be choosers. So I start with 10, and I'm going to show you the list of companies. And with each one, you say, that's a different company. You're right. If you compare any of these companies to Disney as a company, it's going to be very different. These are movie companies. And I'm hoping and praying they get the bulk of their revenues primarily from movies. And that actually turns out to be true. So those are my 10 companies. Some are very close to basket cases. Right? For instance, take Odyssey Pictures. This is a company teetering on the edge of disaster. Because you look at its debt to equity ratio, what is it? 551%. So this company is just barely hanging on. But as I said, beggars can't be choosers. If I start drawing lines through these companies, I don't like this one looks too big, this one looks too small, my sample says. So I have public companies. I looked up the regression betas for each of them. So think of going to Bloomberg 10 times, or 1 time and looking up 10 companies. Those are the regression betas. You say, but they're lever betas. You're right. What do I need to unlever them? I need the market cap. I pull that up. I need the total debt. I pull that up. Okay. Remember what I said firm value was. It's market cap plus debt. So that's the value of each company. This is how much they have in cash. So I'm doing for these companies what I did for Disney. And if I subtract out the cash from the value of the firm, I get the enterprise value, the value of the operating assets for each of these companies. So keep that in mind. Basically, all these numbers for a public company should be easy to get. I've got those. I kept tabs on how much cash is in each of these companies, the percent of value. Then none of them is as bad as Apple is with 22%. But for instance, SFX Entertainment has about 17% cash. So I have the raw data. The raw data I just pulled off because these are public companies. So what do I need to do to unlever the beta? I need to estimate a debt to equity ratio, right? So basically I took the total debt and divided by the market cap. I have my debt to equity ratio each year for each company. Now there are two ways I can approach this. I can unlever each company's beta and try to clean up each company. But the problem with that is my regression beta is screwed up, then I'm working with a screwed up number and doing more screwed up stuff with that screwed up number. So here's what I'm going to do, and it's one of those few times when being lazy actually works in your favor. What I first did was I computed an average across the companies. The average regression beta is 1.35. The average cash as a percent of firm value is about 4.7%. The average gross debt to equity ratio is 129%. I'll come back to that because that's kind of scary. But then I looked at it and said, why is it one? Because you've got this Odyssey in there with this huge outlier, right? This is no longer a financial exercise. It's a statistical exercise. And in statistics, whenever you have big outliers, you can do one of two things. You can take the outlier out, but that's a dangerous game because you start taking outliers out of the sample of 10, you're going to end up with a sample of 3. Or you can use the median, which essentially says, look, the outliers are the outliers, but I'm not going to let them drive my decision. So in the bottom column, I have my median, and that is the number I'm going to use as my numbers for this particular sector. The median levered beta for a movie company is 1.24. The median cash as a percent of firm value is about 3%. The median debt to equity ratio is 27%. So hold on to those 3 numbers, because I'm going to use those 3 numbers to actually estimate a beta for being in the movie business. Any questions before I go in there? If you think about the information you need the regression beta, you need the market cap, you need the total debt, you need cash. None of those numbers should be difficult to get for a public company. Of course, if you have a large sample, it's nice to have access to Capital IQ because then it dumps it in an Excel spreadsheet. So I hope you signed up for Capital IQ, and I kept nagging you to sign up for Capital IQ. If not, you're entering numbers by hand, and I feel no sympathy for you. Okay? So basically, the median numbers are 1.24 for the regression beta. So here's what I'd like to do. I'd like to use that financial balance sheet construct so you can see exactly the process I go through. So what I did was I took my median numbers and I created my median movie company. So basically, based on the 10 companies, I converted to say, if this were one aggregated company, what would it look like? Here's what the numbers would look like. Debt would be about 21.3 million. So basically, I've kind of constructed with standardized around 100. So there's my debt, there's my equity. The regression beta goes with the equity. So the 1.24 is the beta of the equity. The typical movie business is about 97% movies, 3% cash. So if you're wondering where these numbers come from, I'm just pulling the median numbers off from this page. So it's about 3% cash, 97% movies. So let me go through process by process, step by step. I started with the regression beta 1.24. So that's the beta for the equity for a typical movie company. I unlevered the beta using my debt to equity ratio, 27.06%. That's a median debt to equity ratio. And I used the marginal tax rate. I'll come back and talk about this a lot more, but interest saves you taxes at the margin on your last dollar of income. And if you're a US company, that marginal tax rate is going to be pretty close to 40%. You're saying, but they pay less in taxes. That's an effective tax rate. You're right. US companies pay a lot less than 40%. They pay about 26 or 27% in effective taxes, but at the margin on interest expenses, they manage to save about 40% of those interest expenses. So what I've done effectively is what I did for Disney. I took the regression beta. I unlevered it using the debt to equity ratio across these companies, and the unlevered beta for a movie company is 1.0668. I'm trying to be as careful about my terminology as possible. I've gone from a levered beta for a movie company to an unlevered beta for a movie company. But what am I looking for? An unlevered beta for being in the movie business. And a typical movie company is 3% cash, 97% movies. So all I do is simple algebra. The algebra right now is, I know the beta for the company is 1.0668. 3% of it is cash with a beta of 0. 97% is movies with whatever that beta is. It's one equation, one unknown, and you work through the equation. You come up with an unlevered beta for being in the movie business of 1.0993, or if you want to round it up, 1.10. So let me go through that sequence so we're clear. You start with the regression beta, which is a levered beta. You unlever using the debt to equity ratio, the total debt and the equity. Okay? You come up with an unlevered beta for the company, then you clean up for cash. There is a shortcut that many European and Latin American analysts use that skips a step. What they actually do is they net cash out against debt. It's called a net debt ratio. And if you use a net debt ratio, you can actually compress those two steps into one. Your answer will be slightly different than mine because you're making a different assumption about taxes. But that's okay. If you decide to go the net debt ratio, just net debt out for every company. You know what I mean by net debt out? Take the total debt minus cash. And take the average of that ratio rather than the gross debt ratio. So any questions about the steps? Because this is critical to not just your project, but to understanding what you need to do on the quiz, on basically in corporate finance in general. Yeah?
Instead of using the median, could we use the weighted average of, say, the market value or the enterprise value?
The question was, instead of using a median, could we use a weighted average? Here's the reason I would suggest you not. Let's assume you're estimating the beta for a software company, and you decide to use the weighted average of the betas across software companies. You know what you're effectively going to end up doing? You're going to use Microsoft beta for pretty much every company in the sector, and you lose that law of the minute you weight, you start to lose the law of large numbers, right? Because one business is 91%, you're effectively using that regression beta over and over again. So keep it simple. Just take the simple average. If the simple average is being skewed by outliers, take the median. Use the median to come up with the unlevered beta for that sector. And is it going to be perfect? Of course not. But given the competition, which is a regression beta, you're going to come out ahead. Even if your estimate is a little wrong, you're still going to be much better off than using a single regression beta. Any other questions? Yes?
What if it's difficult to find a 10 plus companies?
We'll talk. That's basically where I'm going to go next, right? So the mechanics, so I want to make sure the mechanics are done, because if you get these mechanics, you can repeat them over and over again. In fact, this week's webcast is going to go through the mechanics. If you got it now, don't watch the webcast, because it's going to be incredibly boring. If there are pieces that are still floating around that you can't quite nail down, go through the webcast, because it's about 12 minutes. It goes through the process of coming up with the sample and working through. Yes?
Is there such a thing as operating cash?
Is there such a thing as operating cash? There used to be. And I'll tell you why. And if it sounds like I'm hedging, here's why. If you're a retailer, you know what operating cash is? It's a cash you need in the till, because people pay in cash. You got to give them change. You can't say, look, we have no cash in the till. We'll send you an IOU, right? So that's operating cash. And 30 years ago, it used to be pretty substantial. If you're a retailer, the rule of thumb was 2% of your revenues, you needed an actual currency. Today, when you think about operating cash has to be currency, because if it's invested in fair market, market rate return investments like commercial paper, it's no longer wasting cash. So now it's a minuscule percentage of revenue. So if there's operating cash even at a company as large as Walmart, it might be 60 million or 80 million at any given point in time. So it's so small that I tend to treat it as zero, because if there is operating cash, then you should be moving that cash in with the operating assets. But it's so small, it's really not even worth the effort anymore. Right? Okay, so here's what I'm going to do. I'm going to go to my difficult businesses. So movies was my easy part. You're saying that was easy? Well, you're going to see what gets us into difficulty is we can't get enough of a sample size going. I went to the network business, broadcasting business, right? In the US, when you think about big broadcasters, 4 names come to mind. One, of course, is ABC, that Disney owns. Second is CBS, that used to be owned by Westinghouse. It's now a standalone, but it's, NBC, which used to be part of GE, now is part of Comcast. People can't even find it anymore. So small as a part of a company. And the last is Fox, which is part of News Corp, and nobody can find anything in that company. It's like a big shell game that Rupert Murdoch plays on you. So if I define those 4 companies as my comparables, I'm stuck, right? Because I can't use Fox. I can't use News Corp for Fox because it's too big. I can't use Comcast for NBC because it doesn't work. I'm going to end up with a sample of 1, which is CBS. This is not good. Desperation time. My sample is too small. Here's my first ploy. Move up and down the food chain. What I'm talking about is the broadcasting business doesn't exist on its own. There are companies that feed into the business and companies that feed out. Companies that do well when the business does well and do badly when the business... See, what are you talking about? I expanded my sample to include companies like King World. Have you heard of King World? It syndicates TV shows and sells them to... It used to syndicate the Oprah show and Jeopardy. So it basically makes money off the networks by selling them shows. And guess what? It does really well when the networks are doing well. It does really badly when they do badly. I use Nielsen. What does Nielsen do? It measures ratings. It collects. See what I'm trying to do? I'm really, to me, comparable. Companies don't have to be in the same business. They just, because what does beta measure? Beta measures your exposure to macroeconomic risk. And if you're exposed to the same macroeconomic risk, I'm going to include you in my sample. So I expanded my sample, and when I was done, I had 26 companies. If you're interested, every single one of these spreadsheets, if you go to my website and click on the Applied Corporate Finance book, you can download the entire Excel spreadsheet. You can look at all 26 companies, and you're going to see some companies that that's not a broadcasting company. It's not. It's a company that feeds into the broadcasting business. So that's the first thing to try, is look for companies that feed in and feed out and see if you can expand your sample.
So do you use a beta of 1 to see which companies are related to the industry?
You could. You don't even have to do the beta. In other words, if you look at cross time and the revenues tend to move together, there's a correlation. That's really the test. Is if they move together, then you've got comparable companies. At least, I'm not saying you use this for multiples and pricing, but for betas at least, it tends to work. Okay? So for the network business, I wanted to go through I took the 26 companies. I did exactly what I did with the movie companies. I got the median beta, the median debt to equity ratio, the median cash. I unlevered, cleaned up for cash, and I had a pure play beta of 1.0313 for the broadcasting business. Then I went to the theme park business. And when you think about publicly traded theme parks in the US, I think there are only two, and you can correct me if I'm wrong. One is Six Flags, which is a disaster again, waiting to happen. The other is the Cedar something something. It's a Midwestern. You know. So basically I have a sample of two. Again, desperation time. It's Ohio, right? So you Midwesterners, you think this is the biggest company in the face of the earth. How come you don't know the name of the company? I'm sorry, right? It doesn't appeal to me. Wooden roller coasters are not exactly my cup of tea, right? Now, but I'm sure it's a great company. But a sample of two doesn't help either. So here I went global. Not postal, but global. You know what I mean by global? I couldn't find enough theme park companies in the US, and then I started thinking, why do I have to be US focused? What's the average beta across all European companies? Don't think too long. Go with your gut. It's 1. What's the average beta across all Asian companies? 1. What's the average beta across Latin American companies? One nice thing about betas is betas are already scaled around 1. I don't have to worry about currency differences and PE differences. So and this is the nice thing about having a data set like Capital IQ. The way you start the process is you do a search for the sector you're in. If your sample is too small, then you can say, well, let me try all of North America. If that's still too small, I can say, what about North America and Europe? Well, keep going until you get enough of a sample. I kept going until I had my entire sample of global companies. So there are 20 publicly traded companies across the globe that are in the theme park business. For instance, the Lego theme parks in Europe are owned by a publicly traded company that trades in a European market. So it's companies like those, again, which are in the theme park business. I repeated the process. The unlevered beta for being in the theme park business is about 0.70. So I guess theme parks are a lot less discretionary than we think they are, because I guess if you promise your kid you're going to take them to Disney this year, you're going to take them to Disney even if you lose your job. So it's so there. You can try to spin a story, but that's the unlevered beta for being in the consumer product business. I had no trouble with, because basically what I look for were companies, again, which are global companies, which were in the toy game. So there are enough companies in the space that I get an unlevered beta for ththose companies, 0.6752. I'll make a statement. This is going to sound like I'm being extreme. I have never found a company for which I cannot find enough companies to get a beta if I define comparable widely enough. If you define your company so narrowly that you cannot find other companies, the problem is with your definition. Last week I got an email from somebody saying, I'm trying to estimate the beta for a scallop fishing company, and I cannot find any other publicly traded scallop fishing companies. So I sent an email back saying, what do people usually do with scallops? He said, they eat them. I said, that's food, right? So if you look for food companies, can you find some? He said, of course. Then use them. So if you define a business so narrowly that you get stuck, sometimes it's your definition that is getting you stuck. Okay? And I'll talk about even more creative ways in which you can come up with comparables. But if you're creative, and this is fun, right? This is not accounting. There aren't 15 rules on what you cannot do. Go out and do whatever you need to do to get a group of comparable companies. You should end up with an unlevered beta for each of your businesses. I'm going to pause there and kind of are there any questions on this part of the process? Getting the businesses your company is in and coming up with the betas of being in those businesses. There were 41,000 publicly traded companies at the start of 2015. That's a lot of companies. I guarantee you that no matter what business you're in, there's somebody else in the world who is actually in that business if you define that business broadly enough. What's the next step in the process? Getting the weights for these businesses, right? And here's the problem. I want values that Disney gets from each of these 5 businesses, and I'm never going to get that because these businesses don't trade separately. I have a value for Disney as a company, but I don't have a value for each business. So again, I'm going to stretch. I do know how much revenue each of these businesses. In fact, let me show you the numbers I have for these businesses. I have revenues, operating income, D&A, EBITDA. I have all these numbers, right? If I can somehow use these numbers as a basis for estimating value, then I might be able to use it. And I'll make a confession up front. When companies break stuff down by business, the only number I'm willing to put any faith in is the revenue number. Everything else is part fiction and part tax driven, right? I mean, you're going to find this. So I don't trust the EBITDA number. I know this, they're good accountants, they're solid people. I'm sure they're upstanding citizens. But the only number I'm willing to hang my hat on is revenues. Here's the other nice thing about revenues. It's the only number that cannot go negative. You see why that's going to matter? If I use EBITDA and end up with a negative EBITDA division, what do I do with it? I can't give it a negative value. So if I can somehow get the revenues for each business and convert those revenues into values, that'll be good, right? Because I can get an estimated value by business. So here's what I'm going to do. I'm going to go back a couple of pages again to that studio page that I showed you. Remember I computed the enterprise value for each company, which is value of debt plus equity minus cash. I took the enterprise value for each company and divided by the revenues at each company and came up with an enterprise value to revenue ratio. So you see, what does that mean? Well, based on how SFX Entertainment is being valued, it's being valued at 11.2 times revenues. And I do that for every company. See, why are you doing this? See the median value? 3.05. The median movie company trades at 3.05 times revenues. What am I going to do with this? I'm going to go in and I'm going to take Disney's revenues from the movie business, multiply it by that 3.05 and come up with it. You're saying that's such an assumption. Of course. If you have a better assumption, I'm willing to take it. And I'm not being facetious. If you can find a better way of estimating, I am not stuck on enterprise value to sales ratios. So if you want to do a full-fledged intrinsic valuation of each business, all the more power to you. Go out and do it. But in this case, I want to get done with the beta so that I can move on to the rest of the analysis. So I do this for each business. I get the enterprise value to sales for each business by looking at the comparable companies. So is everybody clear on where this multiple is coming from? By looking at public companies in each of these spaces, I'm trying to get an estimate of what multiple they trade at. I come up with a value of each business. If I add up those values, you know what that is? That's almost an estimated value of Disney as its pieces, right? I value Disney as 5 pieces. Sometimes your analysts talk about the sum of the parts valuation. You hear that in the context of Sony and how it looks like they've done something incredibly sophisticated to come up with this number. This is all they've done. If I could actually claim I've done a sum of the parts valuation, if that number is greater than the actual market value, what am I going to say next? They should break it up. You see how completely, you can do some very strange things based on this, because this is not a valuation, it's a pricing. It's a pretty crappy back of the envelope pricing to begin with, but it's amazing how much of activist investing and equity research is based on this very, very rough proxy of what a company is worth in pieces. That value is what I use to get my weights, and based on my numbers, this is what I get. Disney looks like it's about 49% broadcasting, about 34% theme parks, about 13.5% movies, about 2% in consumer products, and even that is deceptive because even those consumer products probably derive their value from movies or broadcasting, and about 1.25% from gaming. I have the unlevered betas from 3 pages ago for each of the businesses. I take a weighted average. You know what I mean by the weighted average? I take the weight, multiply by each beta. The weighted average unlevered beta for Disney's operations, and again I'm being very specific about the beta that I'm talking about, Disney's operations is about 0.9239. That's Disney's operations. But remember, Disney also has cash. So if I ask you what's the unlevered beta for Disney as a company, I'm asking you a different question. I have to take a weighted average of the 0.9239 weighted by the value that I have for the operations plus 0 times the amount of cash they have. The unlevered beta for Disney as a company is 0.897. You say, oh my God, all these different betas, what am I going to do with them? You will learn to actually kind of deal with each one on its own merits. But this is why when people talk about betas, we need specifics. Are you talking about a levered beta or an unlevered beta? An unlevered beta for the company or an unlevered beta for the business? Because you can't move interchangeably across them because you're measuring different kinds of things. Any questions? So I have an unlevered beta for Disney as a company by building up from its businesses. What's the last step? I need a debt to equity ratio, right? And it has to be a market value, and here I'm kind of stuck. I can get it for the whole company. I know the total debt and market equity for the whole company. But here's what I don't know. I don't know where the debt at Disney is parked. I don't know whether it's in the theme park business, in the movie business, the gaming business. So I'll give you 3 different iterations on what I've done. In the first edition of my Applied Corporate Finance book, in the first 2 editions, I took the lazy way out, which is I don't know what the debt in the divisions is. So basically, I'm going to give every division at Disney the same debt to equity ratio. Very sloppy, but I confess that's what I did in the first 2 editions. Third edition, I woke up and said, this is not right. These divisions have, I know the theme park business probably borrows a different amount than the movie business does. It would be nice if I could park the debt in the right places. So here's what I did in this iteration. Disney did break down their assets by division. Again, I'm completely at the mercy of Disney accounting here. But I'm going to throw myself at their mercy because I really don't see a simpler choice. I assume that the debt at Disney is in proportion to the assets. And again, this is my judgment. You could have used you could have used the average debt to equity ratio of the sector. That's the other thing I tried and tried to back it in. If you do that, just be careful that the debt still adds up to the actual debt. But make your best guess. For your company, this might not be the way in which you allocate debt, but at least give it a shot. And you have a debt to equity ratio for divisions that vary widely. And I was flabbergasted at the consumer product debt to equity. But at Disney, it actually makes sense. You know how Disney makes money on its consumer products now? They don't actually produce them. They license them out. It's almost a fixed revenue stream. If you're going to borrow money, you'd like to borrow it on a revenue stream that's predictable and fixed. So I have a debt to equity ratio for each business. I'm almost there. So the only number here that I actually can observe is the debt to equity ratio for the whole company. It's 13.1%, but I now have debt to equity ratios by division. Last step is I take the unlevered beta, I apply the debt to equity ratio, I come up with a levered beta. So basically, I'm going through the process of levering using that debt to the levered beta equation. I have a levered beta for each company. And once I have the levered beta, remember I already have the risk-free rate and the equity risk premium, I come up with the cost of equity for each of the 5 businesses that Disney has and for Disney as a company. I know it sounds like an incredibly tedious way to get to cost of equity because remember the regression beta, what did you do? Just plugged and chugged, you were done. 9.95%, we said let's move on. Now I'm saying wait, maybe that's not the right cost of equity because that regression beta could be wrong. So based on my bottom-up beta, the cost of equity for Disney as a company is 8.5%, and those are the cost of equities for each of its 5 businesses. This is the bonus you get when you estimate a beta from the bottom up. You think, what are you talking about? I have a cost of equity for each of the 5 businesses that Disney is in. What is the first investment principle? Make sure you invest in projects that earn a return that is greater than your minimum acceptable hurdle rate, right? So let's make this real. Let's assume that you got this table in front of you. You stay on this table. I'm going to play the role of Disney's CFO. Do you want to be the CFO? You be the CFO. I'll be the movie guy. It's so much more fun anyway. Right? And I'm going to come to you asking for money. That's what CFOs are there for. You ask them for money. I have a new project. So I'm the movie guy. Let's give the new project a name. The Lone Ranger 2. This time we're going to make Johnny Depp play like Pirates of the Caribbean because that's the only role he seems to play in every movie. So it's going to be the Pirates of the Caribbean meets Lone Ranger. I don't even know how this would work out. A drunken Lone Ranger with a Tonto by his side kind of going off in different directions. It's going to be another 250. Remember what happened to the old Lone Ranger? I should probably fill in the gaps for those people who don't remember. How many of you saw that movie? That's why the movie actually lost Disney $190 million. It cost $250 million to make. They wrote off $190 million. It was the biggest write-off of a movie in the last 25 years or 30 years. So, but this time I've got it right, which tells you something about last time, but let's not go there. So just as you get ready to shut the door in my face saying, no, you can't make that movie. I said, no, we've looked at the numbers this time, and based on the numbers, we think we can make a return on equity. No movie guy talks like this, but act like I do. Of, say, 10%. I'm sorry, let's make it 9.5%. You see why I picked the 9.5%? It's higher than the cost of equity for the company, but it's lower than the cost of equity for the movie business. See the question I'm asking you, when you look at a project, should you be comparing the returns you make on that project to the cost of equity or capital for the whole company, or the hurdle rate for the business that that project is in? It's a fundamental question in corporate finance that 75% of companies fail. So let's see if we can get it right here, so we can try to convert the other 75%. How many think I should use the company's cost of equity? Nobody? Come on, somebody be the guinea pig. Okay, I'm going to make you the guinea pig. Just hang in there, okay? So if you go with that reasoning, you're going to use the company's cost of equity for all 5 divisions, right? It's a company's money. I'll play the person backing you up. It's a company's money. The company's cost of equity is 8.5%. I'm going to use it across the board for all 5 divisions. Let me ask you, which of these divisions are going to be happy about this choice, and which ones are going to be pissed off? Which ones are going to be happy about this decision I've made to use one company cost of equity? All the risky business are going to say, this is wonderful, I'd love to be part of this company. And all the safe businesses are going to say, what? We can't compete. And they're going to go further, right? Next year when that theme park investment comes in, you look at the returns, it's going to be, because it's a much safer business, you can say, it doesn't pass muster. So over the next 5 years, what's going to happen? Your risky businesses are going to invest a lot. Why? Because they're being subsidized by the safe businesses. Let's be absolutely clear. And your safe businesses are going to get smaller and smaller, and eventually they're going to disappear. How do you think Bankers Trust became an investment bank? In 1981, Bankers Trust was a commercial bank. Then it played this game of commercial banking and investment banking competing for equity. Whoever gets a higher return equity gets our money. Commercial banking could not compete. You become an investment bank. This is almost set in stone. If you use one cost of capital across the board, one hurdle rate across the board, you will become a riskier business over time, because your riskier investments will proliferate. It's not that you're investing in the risky businesses, you're over-investing in the risky businesses. Corporate Finance 101. This is one, if you forget everything else in this class, at least do it after the final exam. This is the one thing I want you to take away, is when you look at an investment, it's not the company's hurdle rate that should matter, it's the hurdle rate of the investment you're looking at. Okay. So in this case, that's the bonus you get. Now let me give you the bad news. I said 75% of companies fail this test. Fail this test in what way? There are actually surveys that ask companies, how do you come up with hurdle rates for companies, for projects? And I think 60% of all large US companies said they use one hurdle rate across the board. And they're multi-business companies. How do you, if the intuition is so clear that you should not be subsidizing risky projects with safe projects, why do you think companies stay with this practice of using one hurdle rate? Many of you worked at companies where this was true. Why do you think they stick with one hurdle rate across the board? One is they say it's hard to come up with. In fact, if the way you get your cost of equity is with a regression beta, you're trapped, right? What's a regression beta for GE? It's a beta for the whole company. If I asked you, what is the beta for GE Capital? You try to run a regression, say, I can't find a regression, so I'm going to use the GE beta. So the first is the way we compute cost of equity kind of traps us, because it means you can get only one cost of equity for a company, no matter how many businesses it's in. Now the second problem is, the minute you start talking about having different hurdle rates for different businesses, a political firestorm almost always follows. And I'll give you a story to bring this home. So about 20 years ago, the Gap was a growing company. It's a long time ago. Okay? It was actually growing by opening, in fact, it used, the original Gap used to be this very disciplined company where they opened another Gap store and another Gap store. Every Gap store was a mall store, and the hurdle rate was 18%. They started growing, and they wanted to grow by opening up 2 new businesses. So somebody from this class, I think the 92 group graduate, goes to work in San Bruno for the Gap. And he calls me just as these 2 businesses come on board. And the 2 businesses they opened were Banana Republic and Old Navy. Now go back to determinants of betas and just tell me intuitively what you would think about these 3 businesses under the same umbrella. company. You got the Gap, you got Banana Republic, you got Old Navy, right? Remember we said betas are driven by how discretionary your product or service is? If 18% is the hurdle rate for the Gap, would you expect first let's go with Old Navy. Would you expect Old Navy to have a lower hurdle rate or a higher hurdle rate? Much lower, because it's much lower price, lower margins, much less, hopefully, discretionary. And Banana Republic is just Gap clothes marked up by 30%, but you don't have to deal with the riff-raff. Basically, it's basically pricing differences. So if you were starting from scratch, you'd expect that the hurdle rate was 18% for the Gap, it would be 15% for Old Navy, and 21% for. So we talked through this, and he thought this was a great idea. And I asked him, what do you plan to do? He said, I'm going to bring it up at the next divisional head meeting. I knew exactly what he was going to walk into. I said, call me after the meeting and tell me how it goes. So he called me after the meeting and he said it did not go well. He said, what happened? He said, one of the divisional heads hated the idea. He said, let me guess. And you could probably guess. Was it the Banana Republic guy? He said, yes, the Banana Republic guy thought this was terrible, that he was part of the Gap family, that it was terribly unfair. I said, what did the CEO, which was Mickey Drexler, that legend in the retail business, what did he say? He said, Mickey really wants Banana Republic to grow, and he really likes this guy, and he didn't want to rock the boat, so he decided to put this off for a couple of years. Put this off in what sense? Continue to let everybody use 18%. This is the way in which these things get entrenched. Nobody wants to rock the boat because often your riskiest businesses are your highest growth businesses, right? So the investment banks don't want to shut down the private equity guys, the hedge fund guys within the bank, because they're the ones where you see, hey, I could grow there. So unless you're willing to make that unpleasant choice up front and say, you know what, you're a great business, but you're also a risky business. I'm not shutting you down. I'm saying earn a return that is justified given the risk you take on, not something that is subsidized by the rest of the businesses my company is in. So that is the end game here, and that is why we spend so much time building up to a beta, because the end, now I can give you the numbers by business. Okay? And in fact, I took Vale, which is, again, one big company, and I broke it down into 4 businesses. I won't bore you by going through all 4 because it's exactly the same process that I use for Disney. Look at the sample sizes though. As you go into manufacturing, you're going to get much bigger sample sizes, and here there's a really good reason to go global. A metals and mining company is a metals and mining company. So it doesn't matter that BHP is an Australian company and Vale is a Brazilian company. You compete in a global commodity space. So oil companies, mining companies, there's a good rationale for going as broad as possible. You're saying, but I can't use Lukoil if I'm looking at ExxonMobil. Why not? You're saying, but Lukoil is more risky. It is more risky, but the place you're going to show it is not in the beta. It's going to be in the, what are the 3 items? Risk-free rate, beta, equity risk premium, right? So you want to show me Lukoil is riskier. The beta is not the place you're going to show it. It's going to be in the equity risk premium. So these are the breakdowns, and you can see I did exactly what I did for Disney. I have an unlevered beta by business, an unlevered beta for Vale operations, and then I used that. And here I did do the lazy thing of assigning the same debt to equity, and I'll give you my rationale. These are all for infrastructure manufacturing businesses. I could not think of a good rationale for why one might not borrow money and the other would. So I left the debt to equity ratio at 55%. You say, how would I know? The only way to know is go look at the sector averages and see if in fact you're in 4 businesses with very different policies on debt. Okay? So essentially my cost of equity by business and cost of equity for Disney for Vale as a company. So again, it's exactly the same process broken down by business. And based on my estimates at least, Vale is about 76% iron ore business, 24% everything else. Okay? All my costs of equities are computed in US dollars. Does that sound strange? Vale is a Brazilian company. Commodities traded in dollars. They actually report in dollars and convert into reais. It's actually easy to work in dollars. If this had been Embev, another Brazilian company, I would have stayed with reais. It's not because I want to go dollars because I'm more comfortable with dollars. In this particular case, I think it actually makes more sense for me to stay with US dollars because of the way the numbers are reported. Yeah.
But in the case of Ambev, aren't they international enough already?
They're very Latin American, but they still There's a much stronger, but they're not selling into a dollar economy. So when they sell in Chile, they're not selling in dollars. The difference with Vale is they sell anywhere in the world, including in Brazil, they sell in US dollars because the commodity market is priced in dollars. Right? They have an exchange rate problem because all their costs are in reais and all their revenues are in dollars, but that's a different issue. We'll come back to that when we talk about financing.
So the riskiness will show up in the equity risk premium and not the beta, but that depends on how you're calculating beta. If you look at the MSCI index, the global one.
You can try this. Beta will never be able to carry country risk. Try it out. Take the riskiest market in the world, you put it against the MSCI, you'll actually get really low betas for Nigerian oil companies. It's not even that. It's such a small percentage. It's just a market cap effect kind of dominates everything else. So I take Luke Oil and run it against the MSCI, I get a beta of 0.2, which means absolutely nothing. That's why beta can never carry the weight of country risk. And to ask it to do it is just asking for too much. Yes?
So if you use dollar to value the Vale, so your risk-free rate will be a dollar risk-free rate.
Right. My cash flows will be in dollars. My discount.
Yeah,
Remember?
however, but if Vale raised that, it's all. I mean, if their reinvestment will all be in Brazil.
Why? They invested in Canada. They invest in. So what does it matter, right? I can take. Remember, that's why I said currency is a choice. I can take a company that does everything in real and still valued in U.S. dollars. I just have to convert it into dollars. So the fact that I have a conversion factor is not the issue. So don't let the way in which a company does business drive your currency choice, because then you might be working with Nigerian Naira and you're feeling awfully tentative about all your numbers because you can't get the risk-free rate nailed down. Right? So the currency in which a company operates should not always be the currency in which you do your analysis if you have troubles getting basic numbers in that currency. Now, let's assume, and this is my point here, let's assume that at this stage you said, no, I want to do everything in reais. It can happen, right? You could pick a company, decide to do everything in dollars for the first 4 weeks. 5th week you can say, no, this doesn't make sense. I want to go back to reais or pesos. There's a very simple way in which you can move across currencies. And if you get this, you crack the code on currency. Remember when I showed you the risk-free rates across currencies, I said the only reason they're different is what? Difference is in inflation, right? If I gave you a cost of equity for Vale in US dollars, which I did on the previous page, to convert it into reais, here's all you need to do. You need an expected inflation rate in US dollars, which is easy. Why is it easy? How do you get it? It's actually the difference between two numbers. Don't ask economists what. Don't use last year's inflation. It's going to be the difference between the T-bond rate and the TIPS rate. You're done. Just move on. I know there are all kinds of other issues. The T-bond rate is a nominal risk-free rate. The TIPS rate is a real risk-free rate. You take the difference. You got the expected inflation US dollars. It's about 1% now. But at the time that I did this, it was about 2%. And the expected inflation in Brazil is tougher because I can't use this approach in Brazil. So there I actually used the inflation rate from the most recent year and hoped and prayed that was a good measure of expected inflation. It was about 9%. If you're in a hurry, you can take the 9 minus 2, 7, and add it to the 11.23, which gives you an 18.23% cost of equity in real terms, the differential inflation added on. If you're not in a hurry, do it right. And what I mean by doing it right is inflation is a compounding factor. So the 11.23% compounded gives me a cost of equity in reais of 18.87%, slightly higher than the 18.23 because of the compounding effect. So if you really wanted to do Vale in reais, not a problem. Just convert it into reais. You need that expected inflation rate difference. And don't spend days or weeks thinking about that expected inflation number. Pick a number and stay consistent with that, not just in the discount rate, but when you do your cash flows as well. It's all going to be okay. Right? Now, Tata Motors and Baidu was a simpler task because both, as I see it, are single business companies. Tata Motors, I used the beta for publicly traded global automotive companies and a levered beta based on Tata Motors debt to equity ratio. So basically I'm starting with the beta for the auto business using Tata Motors debt to equity ratio, Tata Motors tax rate to come up with the cost of equity in rupee terms. And this is the rupee cost of equity because I'm going to do everything in rupee terms of 14.49%. So the risk-free rate is the Indian rupee risk-free rate. The risk premium, of course, came from where Tata Motors actually does business. So that's from the earlier analysis. For Baidu, I use the beta for online advertising companies because that's how Baidu makes money. That again is critical. There are no social media businesses. Social media is a vehicle, just like there were no .com businesses. .com was a vehicle for you to deliver another business. Amazon was a .com retailer, right? There are other .com companies that delivered services. Same thing with social media. Facebook is not a social media company. It's an online advertising company. A lot of potential. I'm not ruling that out. Google is an online advertising company. Amazon is a retail company. So go to the core of how you make money when you think about businesses. In this case, the unlevered beta for online retailers is 1.30. I use the debt to equity ratio for Baidu, which is fairly low, 5%, with the tax rate in China of 25% to come up with a levered beta of 1.356. My cost of equity in local currency terms is risk-free rate in the local currency plus beta times the equity risk premium for China, because Baidu gets all of its revenues from China, gives me a cost of equity of 12.91%. Four companies we've talked about, right? We've talked about Disney, we've talked about Tata Motors, actually 5. 4, 5, whatever. And we've essentially built up to the beta in the same way. Start with the businesses, get a beta, make a currency choice, and stay consistent with it all the way through. Any questions? Here's the fifth company. That's why we kept thinking, we have 5 companies. What happened? The fifth company, of course, is Deutsche Bank. And I'm going to do something similar, but I'm going to skip a step, and then I'm going to ask you why I skipped a step. Here's what I did for Deutsche. I broke it down into 2 businesses, commercial banking and investment banking. For commercial banking, I used European diversified banks. The reason I stayed regional is because of regulatory differences across regions. I'm a little wary about bringing US banks into the mix. Right? So I used European. For investment banking, I had to go global because in Europe itself, investment banks tend to be part of commercial banks. So you got to go to the US and the UK primarily to get investment banks. I've got pretty large sample sizes, and I got a levered beta for each business. And then I took a weighted average of those levered betas to come up with a levered beta for Deutsche as a company. Does it look like I skipped a step? What's a step I've skipped? What did I do for Disney? I got the levered betas for the businesses, then I unlevered it and re-levered it, right? Why am I skipping that step for Deutsche? We give you something to try this weekend if you have a lot of free time. Try to estimate the debt to equity ratio of a bank. No, seriously. And after about 2 days of working at it, say, I have no idea what the debt to equity ratio is, and here's the reason. Debt to a manufacturing company is a source of capital, right? Debt to a bank is raw material. You see what I mean by raw material? I mean, think of an old-fashioned bank. How do you make money? You borrow money at 3%, you lend it out at 5%. Debt is not a source of capital. It's how you make money. So the very notion of debt for a bank is kind of shaky. And estimating debt to equity for a bank is almost impossible. So I throw up my hands and say, you know what? I'm essentially going to assume that all banks have the same debt to equity. And that is going to get me into trouble. Because we do know that there are overcapitalized banks and undercapitalized banks. It's not a traditional debt to equity. It's actually based on regulatory equity. So I'll give you a way out of that. If you really want to differentiate across banks, maybe the way to do it is by looking at tier 1 or tier 2 capital ratios and saying, if I have a lot of regulatory capital, I'm a safer bank. If I have less regulatory capital, I'm a riskier bank. I didn't go that road because I didn't want to open that regulatory capital door yet. But based on my breakdown, I have a cost of equity for Deutsche's commercial banking, which is 8.28%. Here it's all in euros. 9.44% for investment banking. And if you want to break investment banking down into more businesses, go ahead, just be careful. You've got to find enough publicly traded companies in each business to be able to do that breakdown and have a cost of equity for Deutsche as a company. So Disney was pretty complex, complicated, 5 very different businesses. Vale was slightly less complicated. Even though it's in 4 different businesses, the businesses were pretty similar to each other. Tata Motors and Baidu were pretty straightforward because they were single business companies. Deutsche Bank is not complicated, but it does mean that you've got to get over this hump of I can't deal with debt and equity. What's the last business I haven't touched yet? Bookscape, right? You're saying, no way you can. Well, here's the nice thing. If I need a regression beta to get a cost of equity, then I'm stuck with Bookscape. I can never estimate a cost of equity for a private company. But if I estimate betas based on the business you're in, what's stopping me with Bookscape? Do I know what business Bookscape is in? It's a book retailer. In fact, I'll give you the history of how Bookscape ended up in my applied corporate finance book. It's about 15 years ago. The owner of this bookstore walks into my office. I didn't know who she was. She said, I own this bookstore. And I obviously changed the name to kind of not draw your attention to the bookstore. And it's a bookstore that's been around in New York City for about 60 years. So she walks in and says, I don't know you, but I have a question I'd like to ask you. I said, okay. So I own this bookstore. And I said, I really love that bookstore. And she said, well, I'm facing a fight or flee decision. And I said, why are you talking to me? My mind, I'm thinking Sopranos and Mafia and fight and flee, go talk to the FBI. She said, no, not that kind of fight or flee. She said, we've had this business for 60 years. We have got this great lease, but there's a Barnes & Noble that's going to open up. This was in the days when Barnes & Noble was again a growth firm, so we're talking about history here. It's going to open up a block away, and I have to decide whether to flee, which would be give up my lease, my landlord will pay me X million dollars to go away, or fight. And fight, in her case, would be to take the rest of her wealth and put it back into the bookstore to create a cappuccino bar and nice couches or whatever Barnes & Noble has. So I said, so why are you talking to me? She said, I need to know what rate of return, she didn't use exactly those words, I would need to make on, because it's the rest of my savings going back into the bookstore for it to be a viable investment. What was she asking me for? A hurdle rate on an investment, right? How much do I need to make? Say, how the heck have you run your business for 60 years without a hurdle rate? Lots of private businesses, that is the case because you were in the right place at the right time 50 years ago. Your grandfather started the business. It's been running on autopilot for 50 years. You didn't have to stop and think about hurdle rates. She said, can you help me? I said, yeah, I guess so. She gave me a $200 gift certificate to the bookstore. And I said, okay, that's good. I love books. I'll use it. And I need a beta for being in the book retail business. So I went into Bloomberg at that time and said, find me some book retailers. It came back with 2. Desperation time, right? Up and down the food chain. I said, I can't find enough book retailers. I can find businesses that do well when book retailing does well. In this case, publishing companies. I brought those in. I came up with a sample of 12. You're saying only 12? Well, she gave me only $200. It's not like I'm going to spend 2 days doing this. I said, 12, that's good. For $200, that's about the service you can expect from me. Eh? 12 is not bad. I mean, I stopped with 10 for Disney. I looked up the regression. So I did exactly what I did for Disney. Get a regression beta, get the... So I finished the process. I come up with an unlevered beta for being in the book business. So I take the levered beta, I unlever it, clean up for cash of 0.7584. I'm almost home, right? I have an unlevered beta for being in the book business. What do I need from the owner of Bookscape to actually get a levered beta? I need a debt to equity ratio. I need a market debt to equity ratio. Now you see with private companies, the first block you're going to run into, private companies have no market debt, no market equity. So I tried something that almost never works. I called the owner of Bookscape and I said, can you give me a target debt to equity ratio for your business? And she said, a what? And I hung up the phone. Because she said, my target debt to equity ratio is 25%, and I plugged it in and moved on. You know, the only time I get an answer I can use is there are some private businesses I call and the owner says, I never borrow money. Then that's easy for me because then I use a 0 debt to equity. So she said, I have no idea what you're talking about. I said, do you borrow money? She said, yeah, I have a lease. I said, okay. I have my work cut out for me. I need a debt to equity ratio. I don't have it for your business because you have no market equity, but I do have it for those book companies. The median book debt to equity ratio for book companies is about 21.4%. Ignore the 369 because again you got a crazy outlier driving that. 21. I basically plugged in, you see what I'm assuming? I'm assuming if you're a private chemical company, your debt to equity ratio, if you were trading, would be roughly similar to what public companies in the space use. I came up with a levered beta of 0.8558. I'm almost home. Take the risk-free rate plus beta times, and here life gets easy because you're a U.S. company, get all your revenues in New York, the U.S. equity risk premium. I came up with the cost of equity of about 7.5%. So think of what I'm telling her. Put your money in the business. If you make more than 7.5%, you're going to be okay. But I almost called her and gave her this number when I did remember something about how I computed this number. To compute this number, what did I use as my measure of risk? I use the beta, right? When I use the beta, what portion of the risk am I capturing? The risk you cannot diversify away. What do I assume happens to the rest of the risk? That investors, you see how that reasoning might work with a public company, but in this case, what did she tell me? She said she was going to take the rest of her wealth and do what? Put it into the business. If I went to her and said, well, use a cost of equity of 7.5% risk, and she said, how come it's so low? And I said, well, there's a lot of diversifiable risk. You know what she's going to tell me? Diversifiable by whom? I've got my entire wealth tied up in this business. So here's my question, and it's actually an intuitive question, then we can start to put a number. If I come up with a cost of equity for a private business based on a beta, and the way I do it for a public company, am I going to underestimate the cost of equity for this company or overestimate it? I'm going to underestimate. You're the owner of a private business. You're going to say, this number makes no sense to me. I'm exposed to all the risk in the company. Now, private business appraisers have known this for a long time, and about 20 years ago is when I had my first exposure to private business appraisers. And so how do you deal with this fact? That all your numbers come from public companies, you're plugging them in to come up with cost of equity and capital for private businesses. What do you guys do? And they said, it's easy, we just add 10% to it. I said, why 10%? And you know what the answer was, right? It was here when we got here. And I said, this doesn't work for me, it might work for you. I want something I can hang my hat on, so I'll take you through the process, and this is very idiosyncratic to the way I think about this. This is not the universal way that people think about private businesses. And what I did was an algebra problem. Here's the algebra problem. If you think about the beta that I have, it measures just the market risk in the company, right? That's the problem. You're exposed to total risk. I'm capturing only the market risk. If I could somehow scale the beta up to capture the rest of the risk, then that beta will be a beta that captures all risk. So I took the retailers and I looked at, remember the R squared measures the proportion of your variance that comes from the market? The average across, or the median across the retailers, or the book companies, was 26%. That's a median R squared across the companies. There's a little statistical barrier to get over. Beta is a standard deviation measure. It's not a variance measure. It's based on standard deviation. So what I had to do was take the square root of the R squared, which of course is the correlation coefficient. And the correlation coefficient for retail companies is about 51%. See, what does that even mean? When you invest in a typical book company, 51% of the standard deviation is from the market, 49% is from the firm. Let's make it 50-50, right? When I give you a beta of 0.8558, I've given you the beta for just the 50% that is market risk. And what's your problem? You're exposed to the remaining 50% as well. So tell me if this strikes you as unreasonable. If you're an investor who has all of your wealth invested in this business, I would expect your beta to be almost twice as high, right? Because you're exposed to the rest of the risk. That's what I call a total beta. And the total beta captures not just the market risk, but also the firm-specific risk. And it's because you're not diversified. So that beta of 1.68 is what I plugged in to give her a hurdle rate of 12%. And that's the number I delivered to her as her hurdle rate. And she had two questions. The first was easy to answer, and I gave the answer. The second I knew the answer to, but I could not think of a kind way of giving the answer. So I called her and said, look, your hurdle rate is 12%. And she says, well, what's Barnes & Noble's hurdle rate? They're right down the street from me. What's the answer to that? They're a public company. Their investors can diversify away all the bad stuff. Their hurdle rate is only 7.5%. So I said, their hurdle rate is 7.5%. Then she asked me the tough question. She said, if my hurdle rate is 12% and their hurdle rate is 7.5%, how the heck am I going to compete with these people over the long term? You know what the honest answer to that question is? You cannot. There are lots of other factors as well. When I moved to New York, I think there were 36 independent bookstores in the city. I think Shakespeare just closed down, so I think we're left with like 4 or 5 bookstores. Part of this is the drop in brick and mortars retailing, but part of it is the fact that as public companies enter this space, you drive out private business, and it's not the first business this has happened in. I'll give you a couple examples. You know how Blockbuster got built up as a company? You remember Blockbuster? Remember those places, the big stores with tapes that used to be on the wall, and you'd actually pick a tape and they'd charge you $5 for a day and hope you didn't bring back in time? Because they made their money on the, oh, you were late 3 days, that's $550, right? You offered to buy the tape, they said, this tape is priceless. We can't sell it to you. But Blockbuster was built up by going around the country buying individual video rental stores and bundling them together. Heard of Browning Ferris? What business is it in? Not a glamorous one, it's in the trash business. The garbage collection business. You know how Browning Ferris was built? It went around the country buying up garbage collection businesses. In fact, New York was their last holdout. You know what? You've seen your version of The Sopranos. You know this bit. In fact, the FBI had to come in and break up the process because every time Browning Ferris would find a willing seller, the next day that willing seller would have 2 broken knees and he'd become an unwilling seller. And he said, no, you know what, I've changed my mind. So Browning Ferris was, so this is something that will happen in business. It's kind of depressing because you think about mom and pop businesses. I'll give you one final example. 25 years ago in this country, if you walked into a pharmacy, most pharmacies were owned by the guy standing behind the counter. The pharmacist was often the owner. Today you walk into a pharmacy, you look up, what do you see? CVS, Duane Reade. In business after business, this will happen. Not because private business owners don't work hard. They work harder than public company owners often do. But because this is not a great way of taking risk. It's not efficient to put all your money in one business. Okay? So what I'd like you to do, and for the moment you have the quiz to come, is at some point in time start breaking your company down into businesses and do it sooner rather than later when this is still fresh, and try to come up with a beta for your company and its individual businesses.
For a private company, have you ever considered using the book value of the equity? Why is that?
Book value of equity is even more meaningless at a private company than at a public company because the accounting standards are all over the place. It's driven by tax reasons. You don't capitalize things if it doesn't work for you, if you can expense something. In fact, private businesses often use the fact that you're allowed to expense up to $50,000 in capital expenses, so you keep buying copiers and physical assets, and because it's below the $50,000, you expense it every year. So your book value doesn't reflect what you actually own. So if book value of equity is meaningless for a public company, it becomes even more meaningless for a private company.
Is it okay? We entered a competition and we need to value a private company. Is it okay if we send you our stuff? Thank you.
Two questions. The first one is, if you're not going to use a company-wide,
I'm not going to use a regression beta. I still need a company-wide beta and a cost of equity if I value the whole company, right? So, but the way I'm going to get that company-wide beta is by taking the weighted average of the individual.
you're making the same argument that the equity analysts are making about breaking up these companies. So what's the point?
Well, I think that if you want to break up the companies, it's got to be based on valuation of the individual businesses. That's a lot deeper than what I did, right? Because what did I do? I took the revenues at Disney theme parks and I applied a multiple of revenue. Let's face it, Disney theme parks are a game of their own. I can't apply. So when I start pricing things, I've got to be a lot more careful because I've got to control for differences across companies in terms of risk and growth. And this is, so if you ask me for a 10-minute quick, sum of the parts valuation of Sony, I do this. I take the EBITDA or revenue of each business, multiply by the industry average, multiply, and say these are the valuable pieces. But if I then buy Sony as a company and then try to break it up and collect the money, I might be deeply disappointed in what I actually get when I try to sell Sony's movie business, the Sony's electronics business, the Sony smartphone business, the Sony computer business, because the numbers that I ignored are the numbers that are going to come back to haunt me. So if you're going to do a sum of the parts valuation, it's a lot more work than taking some generic revenue or EBITDA number and applying the multiple.
The second thing is, I think for the investment plans, you can use an unlevered beta.
I'm sorry?
I think for the investment plans, you can use an unlevered beta.
Be careful. First is how do you come up with an unlevered beta?
I mean, any debt beyond a year for them is...
Yeah, but I'm saying it's a levered beta and the unlevered beta are the same. It's not the same thing as saying it's an unlevered beta. Because the banking is the best reason. If you use absolutely no leverage, take an all-equity funded bank, you never see one. It's actually very safe business.
I'm separating the investment bank from the commercial.
Investment banks are kind of pain in the neck to even think about, right? Because what you're talking about as equity is a slice of some deal which might be very, so your risk is often a derived risk. So you can have $2 billion invested in two different deals and very different risk exposure because it's not the business you're in, but the business you invested in. Do you see what I'm saying? Which is, it's very difficult because what you're observing with an investment bank or an asset management company is what they've invested. So if I took a mutual fund, say, well, let me look at what they've invested, it's telling me nothing because until I look at what they've invested, their demand is a derived, their risk is a derived risk from what they've invested. So you can have two investment banks that look exactly the same in terms of the categories they've invested in, but they can be wildly different in terms of their risk exposure because they can say securitized loans, right? That's a category they give. But you can have safe securitized loans, a very risky securitized loan.
Issue you can hold.
Exactly. So there are all these little nuances that kind of kick in that make it very difficult. And that's part of the problem you face in valuing these banks is you have this outside number that you're getting by looking at a very opaque company. But if it's an opaque company, it's hiding a lot of bad, risky stuff.
Yeah.
Which is and that's why I think banks collectively are getting priced down, especially the money center banks and big investment banking arms, because people don't trust them anymore.
Yeah. They don't trust
They say your beta is really like 10. I don't see it yet, but I know it's coming, right? And so that's, I think, become the problem, is they're too opaque for us. I think we need different kinds of disclosure requirements from banks. It's not even a regulatory capital requirement. It's a disclosure requirement which is risk-based rather than asset class-based, right? Because right now it's just based on asset classes. Asset classes are just way too broad for me to capture. I mean, even the risk-adjusted assets you get are based on some very simple mechanistic rules that they play games on. You know? So I think that with investment banks, the risk side, you almost have to take a deep dive in what exactly they do rather than the surface level numbers on where they're invested to get measure of risk.
So you'd be pushing for Glass-Steagall.
Different, and I think actually I would not have invested in money. I own stock in JP Morgan. I think they'd be worth more as two separate businesses. I think it's actually in their interest to take the push towards breaking the businesses down. That if they were actually a banking and they'd be worth about 20. There, I think that some of the pieces now are actually worth more than what they are now, because what's happening is
$18 billion of synergies.
there's bullshit. It's absolute bullshit. I don't believe it for a moment. But Jamie Dimon has to say that. What else can he say? You guys are right. We should